continuing on from our first session in this chapter, in the previous session we looked at what is a group, how is it formed. Okay. Now, if you remember, we said that we had a parent and subsidiary relationship, and we only have a subsidiary if we have control over them. And remember, we acquire control usually by purchasing greater than 50% of their ordinary voting shares. And if the parent has control over the subsidiary, we treat the parent and subsidiary as one single entity. And as such, we must prepare financial statements to reflect the single entity. Okay? Remember, to reflect that concept of substance over form. Now, the first thing we're going to have a look at is having a look at the consolidated statement of financial position, essentially the group statement of financial position. Now, remember, with F3, you have got to see the bigger picture and prepare accounts in full before you can then drill down to do specific areas in exam-style questions. So we need to have a big overview of what the consolidation process is about before we can pick certain bits out to do in the exam. So, can you see then that in your notes we have XYZ Group, Consolidated Statement of Financial Position as at the 31st of December 2011. So it would be the name of the parent company, Group, Consolidated Statement of Financial Position. Now, when I refer to the Consolidated Statement of Financial Position, I might write CSFP, just because it's easier. Okay, so CSFP stands for the Consolidated Statement of Financial Position. And can you see in your notes then, it looks pretty similar to what you've learnt as a Statement of Financial Position already. But there are some key additions. Now, because we are treating the parent and subsidiary as one entity, any assets and liabilities of the parent and the subsidiary get added together because the parent company controls their own assets, but they also control the subsidiary's assets as well, even though they may only own 80% of them, let's say. So, under non-current assets then, can you see property, plant and equipment? Well, we're going to take all of the parent's property, plant and equipment in their statement of financial position and add that to the subsidiary company's PP&E on their statement of financial position. Now, you'll be given the parent company's SFP and the subsidiary company's SFP. Now, all you're going to do is pick off the two figures that you've been given in the question and add them together. So you open up a bracket, parent plus subsidiary. That's not too bad, right? So add them together and consolidate all of it. We have control over their non-current assets. Now, we then have a line for goodwill. And goodwill is always a working. Now, in reality, when you buy another company or when you buy control in another company, generally the price you pay will be a lot more than the value of that company's net assets, their assets minus their liabilities. Now, if you've got the book value of their net assets, assets minus liabilities at, let's say, 80 million, but you paid 100 million in order to acquire those assets and liabilities and acquire control over them, well, the difference of 20 million must be goodwill. Now, goodwill arises due to the excellence or reputation of a business. It's something that the business has that generates them income, but it's not tangible. You can't touch it. Okay? So it wouldn't be something that the subsidiary company would recognise themselves. It would be something that the parent would recognise because they're buying into a good thing. They're buying into the good reputation and excellence. So when you're buying shares, what you are buying is control over their net assets, their assets and liabilities, their things, but you're also buying the goodwill, the excellence or reputation. And excellence and reputation can only come from the people that actually run the business. So, as me as a tutor, for example, yeah? I would contribute to the goodwill of Interactive, yeah, to their good excellence and reputation. But Interactive wouldn't show me as an asset on their statement of financial position. Okay, they wouldn't do that because I'm not tangible. You can't touch me. But if someone was to acquire Interactive, not only are they buying, the assets and liabilities of Interactive, they'll also be buying the people, yeah, the people that contribute to the excellence and reputation. And as such, because we'll be buying into a good thing in the subsidiary, goodwill will be created. And you can see then that we have a W next to that, will need a working. But it's an extra line that you need to add in to the group's accounts. Now, we then move into current assets, inventory, receivables, bank and cash. Well, again, the parent company controls the subsidiary's current assets. Remember, we can tell them what to do. So, inventory, receivables and payables, because they are assets, we take the parents and add the subsidiary's assets to them. We control all of them. And again, you'll be given those figures in the question. You just add them together. Total assets then will be the group's assets, the parents and the subsidiary's assets. And assets in this consolidated statement of financial position is all about, and all it shows is what assets the group controls. So the group controls 100% of their assets. We may only legally own 80% of their assets, the subsidiary, but we control all of it. Okay, we saw that in the last session. So the group controls all of the assets, so the asset section of this statement of financial position for the group will be based on control. Remember, that's a really important concept that underpins everything that we do in this chapter, control. Now, the entire statement of financial position can't be based on control. For example, equity will be based on ownership. Okay? We can't avoid the legal form forever. Yes, we control all of the subsidiaries' assets and liabilities, but we only own 80% of their shares, and therefore we would only be able to contribute and get 80% of any dividends that they pay out. Because you remember, the other 20% would be the non-controlling interest, and they would get their share of the profits through dividends as well. So, equity then, share capital. Now, share capital and share premium, if it's there, is only going to show the parent's equity, the parent's share capital and share premium. Now, I want you to ask yourselves this at home. Who are you preparing the consolidated statements of financial position for? Who wants that information? Would it be the owners of the parent shareholders, or the owners of the subsidiary shareholders? Well, it's going to be prepared for the parent shareholders. Do you remember we said that the parent company's own financial statements will just show 100 million cost of investment? We need to tell the parent shareholders what their money that they have invested into the business has bought them. And it's bought them a controlling interest in the sub. So group accounts are prepared for the parent shareholders. And as such, it's only going to be the parent shares that they're going to be interested in, the parent shareholders. So the parent shareholders will only be interested in their share capital that they've invested, and also any share premium. So the rule is share capital and share premium is parent only, because we're preparing these accounts for the owners of the parent shareholders. We then go on to retained earnings or accumulated profits for the group. We can see that that's got a W next to it as a working. So I'll talk about that in the next session. Okay, we'll talk about retained earnings when we do a numerical example on this. So, subtotal, bring the total across. That would be the owner's equity. Okay, so that would be the parent's equity. But we then have to show what we don't own in the group. Now remember, group is controlled by the parent. But what does the parent own of the group? Well, they own all of their own assets and liabilities and 80% of the subsidiaries. But we have to show that the parent doesn't own all of the group. They control all of it, but they don't own all of it. We then have to show the non-controlling interest, the proportion of the group that we don't own. In other words, 20% of the subsidiary, let's say. We have to give them their share of the equity in the subsidiary and reflect that in the group accounts. We'll see that working later on as well when we do it as a numerical example. The important thing to note, though, is that the parent's equity plus the NCI, the non-controlling interest, so I'll just abbreviate that to NCI, is going to equal group equity, which means then that equity in the consolidated statement of financial position is based on legal ownership. You can't avoid the legal form forever. Remember, we only control assets and liabilities of the sub, but we only own 80% of it, let's say. Moving on then, any non-current and current liabilities, again, for the parent, they control all their own liabilities, but they also control all of the subsidiaries' liabilities as well. And as such, any lines for liabilities would get consolidated parent plus sub, much in the same way that we did with assets. So liabilities in this CSFP would be based on control. Just like we said up here. The group controls 100% of the liabilities. And the group controls all of them. We can tell the directors of the sub whether to pay off a liability or not. We have control. So assets and liabilities are consolidated on a line-by-line basis. Consolidating parent plus sub, parent plus sub, parent plus sub, all the way down. Equity, though, has, based on ownership, we do have several workings that we'll need to do for that. But really, the only new things that you see here is the fact that we consolidate assets and liabilities, and we have two extra lines, okay? Goodwill and non-controlling interest. Now, what you'll see then in subsequent pages of your notes is the breakdown of those three workings for retained earnings, NCI and goodwill. But I'm going to talk through them through the first example in your notes. So in the next session, we'll talk through those workings. But what I would do is maybe put a post-it note or something on those workings after this page, just so you have it as a reference when you're doing questions yourself. In the next session, though, we'll actually do a consolidated statement of financial position from scratch and see how we do those workings.